Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. Okay, choppy day in markets yesterday. Obviously, the Credit Suisse story, issues there spooked European indices, which dropped over 3% on the day, which was like a 2 sigma move. So really the bottom falling out of Europe a bit there after being so resilient for so long and outperforming US markets, really struggling there. Nasdaq was actually up on the day, up 40 basis points. So a bit of a rotation back towards tech, being driven by this large repricing in interest rates. So those mega cap cash cows are basically being considered like safe havens a little bit, as money flows out of cyclical sectors and things like that. Safe haven flows also persisting in gold, which put in another 80 basis points. That puts gold up 6% week on week, which is a 2.3 sigma move, which is pretty good. Silver also benefiting there. And then, like I said, these cyclical commodities really taking it on the chin. Oil down nearly 5%. Nat gas, uranium, copper down 4%, breaking below that $4 level. So really struggling on the commodities front as markets start to now contend with the idea that this banking crisis will lead to a recession faster than we sort of expected. All right, looking at vols, implied vols were higher in the US, but really it's all about Europe, right? Up 5 to 6 vol explosion. We pretty much said it yesterday, right? European vols are coming from a lower base. We've suddenly started moving. Those vols are going to explode, and that's exactly what they've done. But to the extent that Eurostoxx vol now trades at 26 versus S&P at 23, we haven't seen European vol trade above US vol pretty much since the Ukraine war, when that kicked off about a year ago. So, we've got that going on now. Pretty not unprecedented. I mean, historically, when I used to trade for the banks, European vol used to always trade above the S&P, but we haven't seen it for a while, and it's not the norm these days. But given what's going on in Europe, that's kind of where we are now. Okay, commodity vols were also bid again. You can see a lot of green here, all of them up. Really, oil catching the strongest bid there, up another 4.5 vols, looking quite rich. Positive carry in oil, also positive carry in uranium. Whereas if we look at carry, negative carry still in precious metals, which are moving around quite well relative to their vols. If we look at carry across equities, we've got positive in the US and China. We've got neutral to negative in Europe, which is obviously moving around like a madman. If we look at skew exploding, these percentiles, we have not seen these in quite some time, 80% and above. We don't think this is sustainable. We do think this is a bit of a panic move in skew, where everyone's like, oh my God, Credit Suisse is going to go bust. What's going to happen? Systemic risk, that sort of thing. Now, having seen this sort of stuff before in my career, like 2008, whilst I do like the idea of using these extremes in skew as a signal that we're getting pretty damn close to peak panic, and that is making me more bullish from a tactical perspective, that doesn't mean you then go and fade the hell out of the skew and take a load of tail risk and crash risk, right? So using the skew and the moves in the skew to inform you that things are getting a bit stretched to the downside is fine, but just don't go and fade that risk, okay? There are smart ways to play the upside safely, and that's what this channel's all about and is going to help our subscribers to achieve. Okay, moving on. So we said Credit Suisse got bailed out. So the CDS on Credit Suisse, credit default swaps, went ballistic, right? So this is Lehman's crisis. We had an uptick, but this is where we got to here. So basically, Credit Suisse 1-year CDS was pricing in a 30% probability of a default. Okay, so it was pretty dire, which is why the SMB had to step in, really, right? The big shareholders out of Saudi pretty much said, nah, we're not putting any more money in, citing regulatory reasons and things like that. But the reality was, if they weren't there to backstop it, someone needed to, because deposits were flying out the door. Okay, so a proper banking crisis. But now Credit Suisse has been sort of thought of as the weakest. Deutsche Bank's next in line. So clearly, if you look at the CDS, that really did show you where the most stress was. But other banks in Europe, their CDSs aren't moving anywhere near as much, right? So it does seem relatively contained, especially now that the SNB have stepped in. Okay, French banks did get battered though. They were down 10% yesterday, as we flagged. But once the SNB stepped in, there was a knee-jerk rally of about 2% in European markets. So that did kind of help stop some of the panic. And, ECB were asking European lenders to disclose their exposure to Credit Suisse. It was all starting to have some echoes of 2008 and what happened with Bear Stearns and Lehman, basically. Now, ECB's Lagarde has been adamant that she's going to hike 50. They've still got to get inflation under control. It does look like a policy error is coming, but markets didn't believe it and basically took it from 50 bips down to 25 bips pricing. So markets are calling bullshit on Lagarde and saying, yeah, you can say what you want, but if you do this, it's kind of suicide, right? So we'll see what happens today. Fed Reserve rate expectations also plummeting. This is now the rate expectations for the end of this year. We're looking at 100 basis points worth of cuts being priced in now for the end of this year. This is unbelievable what has happened in the space of like 8 to 10 days, right? So you had Powell in Congress talking about 50 basis points being on the table if the data warranted it for next week's meeting. And now suddenly the rates curve is pricing 100 basis points of cuts. They're pretty much saying we might get one more hike next week, then we're done, and cutting starting in June, July, basically, right? That's pretty much what the rates market is pricing. Now, Powell's going to kind of have to confirm or deny this to some extent in his presser. And it'll be interesting to see, because if he does confirm the dovish pivot that's been priced into rates markets, then we may well get a real big lift-off type move in equities because the pivot's here, right? We haven't quite got it yet because you've got cyclical stocks, you've got banks that are under pressure, but you are starting to see mega cap tech catch a bid. We're even getting the rubbish sort of junky tech names like the ARC names. They're even catching a bid, right? As duration catches a bid as rates come down. So we do think a tactical bottom may be near. We're seeing a lot of signs of peak panic. We've got obviously OPEX this Friday. We've got VIX expiration next Wednesday. So we've got a few of these derivatives things that need to maybe roll off. And you also need to see what Powell says to get the green light. But we do think a risk rally into April, into Easter time, is potentially on the cards. And then throw into that positive seasonality around April as well. You know, that there's a lot of things stacking up to suggest a short-term rally at the very least may be on the cards. Okay, so that's kind of what we're trying to set up for across our various portfolios and the ideas we're putting on. So we mentioned like the bond volatility, right? Rates vol has gone absolutely ballistic. Front end rates vol especially. So this is the move index here, and the move index is like, you know, back to COVID highs. VIX is nowhere near that. But let's home in a bit on 2-year rates and on 30-year rates, right? So looking at 2-year rates since November, you can see the range that this thing has had is getting wider. Okay, so it's showing you that the rates volatility in the 2-year is getting bigger and bigger, right? The range is expanding. Okay, whereas if you look at the range of the 30-year rate since November, it's doing the opposite. It's compressing. So whilst you are getting moves in the long end, it's well within the range that's respected since November. Okay, so whilst the move index is reflecting short end rates and how much they're moving, I would argue I think there's less stress in the long end of the curve. Now that the recession is back, is coming in, the rates cuts are coming in, all that stuff, I actually think that there's more potential for some stability in that long end of the rates curve. The short end is anyone's guess. I mean, they could hike 50. Well, I don't think they can hike 50, but they could hike 25, and within 2-3 months, they could be cutting 100 for all we know. Front end, no one's got a clue, hence why this expansion of this range. But in the long end, I think there's a bit more stability, and it's not quite as scary to be selling vol in the long end of the rates curve. That's kind of how I'm looking at it, right? So the way I would do it, looking at our vol dashboard on TLT, obviously it's had a bit of a move up. So we're screening as selling calls here, but the vol is very expensive, right? So rather than sell calls, I kind of think something a bit more delta neutral makes sense. So I'd be in that sort of camp here. Now, I wouldn't want to sell outright vol. You look at the curve, it's quite expensive in terms of it's backwardated here. How much gamma do you want to sell versus how much vega? I think a nice sweet spot is kind of May rather than April, which is a bit more gamma. Carry wise, we're quite neutral, but you know, I think we probably do stabilize post FOMC. So I'm kind of looking for some sort of stabilization. So I've landed on the idea of so that's the idea for today. Thanks as always for listening. Good luck out there, and I'll catch you guys tomorrow. Cheers.